quick note, this video is sponsored by Gabby, the #1 insurance compare website on the market. If you're interested in saving some money on your car insurance, tap the link in the description box below this video, upload your current policy, and Gabby will shop your current insurance rates for you, let you know if you could save some money. You could use that savings to buy some stocks on the dip. Now let's get into the video. What's going on, guys? Freddy Servant here. Welcome back to another YouTube stock video. Tech stocks and any type of momentum and growth stocks continue to get slammed in the market. Some stocks are down 30, 40, up to 50%. In this video, I'm going to talk about 3 stocks that I'm continuing to buy shares in, and those stocks are down 60-70% from their 52-week high. So these are stocks that you at least want to put on your watch list. Now, the overall market just seems to be not liking anything tech, and this is really where a lot of my overall portfolio is invested in. I'm invested a lot in tech stocks, and some of these stocks have been just getting slammed recently over the past 3 weeks. Some are down 20, 30, 40% in my portfolio. So what I have decided to do is to double down on the stocks that I am completely convicted in. Now, recently, these 3 stocks that I'm going to talk about have released their Q1 2021 earnings, and they have just blown out the water in growth, in revenue growth, and these earning reports have just been completely strong. 2 of these companies have no debt. The business models, the fundamentals are great, but it just seems like the stock market doesn't care about fundamentals right now. Doesn't matter if the fundamentals are strong. Stock prices on certain tech stocks are just getting slammed and continue to keep falling. Now, the first stock that I'm going to get into is Root Insurance. Now, Root Insurance is a digital insurance carrier. They just got licensed to do their auto insurance product. They just got licensed to provide that in 48 states, and they are licensed to do auto and home in over 30 states. Now, some of their financial and fundamental Q1 2021 highlights are their direct written premium increased 23% to $203 million. So they just had their first $200 million quarter in written premium. Now, the direct earned premium increased about 11% to $160 million. Now, their direct loss ratio improved 22 points to 71%. Now, this is where their company differentiates themselves from legacy insurance companies, is they leverage their data and technology to make sure that they're insuring only good drivers. So as they are continuing to write more premium, and as their data helps them lower their claims, and if there are any claims, to process those claims faster, that's only going to make this company more profitable. Now, obviously, Root has only been writing business for 5 years. They're not profitable yet, so it's going to take some time to see this company become profitable. In my guess, maybe 3 to 4 years out, but this is a long-term play for me. Now, Root is one of the heaviest, shortest companies on the stock market right now. They are being shorted heavily, but obviously they are getting some support from retail investors and I think some institutional investors that believe that this company is going to continue to grow. Now, their gross profit increased by $23 million to $6 million total. And let's go over what is really fueling this growth for Root. Several factors contributed to their 23% year-over-year increase in direct premium. And the first is just a better product at a better price. And in their Q1 2021 shareholder letter, it states at the heart of what drives Root's growth is their product. Their business model is proving themselves out. As we continue to build better products for our consumers, we in turn expand our customer base. We do this by meeting consumers where they are with the products they need at the price they want. Driving year-over-year results were substantial product improvements, including increasing flexibility around payments and coverage. That was probably huge during COVID and customers obviously not driving more, staying more at home, and then being more flexible on their payments and the type of coverages they were offering. Reduced the amount and quality of data needed to produce quick and accurate driving scores, and making it easier for consumers to join us at key moments through their partner platform. Now, number two, and a key factor to their growth, is their data science marketing. So it states in their shareholder letter, our data science advantage is the bedrock of our entire company and touches everything we do. We are increasingly leveraging proprietary data science to design and implement highly targeted, highly efficient performance marketing programs that allow us to personalize marketing design, messaging, and cost by consumer segment. In Q1, we began expanding this program in additional marketing channels and customer segments, fueling their growth. Root is in the early innings of leveraging data science and customer acquisition, and we expect large-scale improvements to be made over the coming quarters that will drive future gains in growth and efficiency. And number three is earned media. Our investments in brand have delivered significant earned media impressions and increased our awareness metrics. Now, they have a partnership and sponsorship with NASCAR driver Bubba Wallace in support of his commitments to progress and change, continues to earn Root significant impressions both in TV and media. I've had family members, friends reach out to me saying that they're seeing Root ads everywhere. And obviously, number four is their market expansion. Root is now licensed, like I mentioned before, to write auto insurance in 48 states, and that includes 11 states that they just added during Q1 2021. And seasonality, like most auto insurance providers, Root's traditional experience outsized growth in Q1 of each year as consumers shop for new policies. This year included similar seasonality intensified by the government issuance of stimulus checks, with our largest month of Q1 premium coming back in March. So their pricing continues to improve. They continue to have effective marketing that's allowing them to acquire customers at a cheaper cost. And as they continue to drive loss ratio and improve their loss ratio, that's going to make them more profitable in the years to come. So guys, I'm super bullish on Root. They had a strong Q 2021, and I think that they're going to continue to fuel growth as they are the leading digital auto insurance company with their AI and their data. It's going to continue to help them ensure the right type of customers that are going to make them profitable. Now, the second company that I want to talk about is Expi, or Exp Realty. Now, this company's share price has fallen about 60 to 70% in the last 3 months. However, they are continuing to expand and grow like crazy. Expi revenue in the first quarter 2021 increased 115% to a record of $583 million in the first quarter of 2021. Gross profit increased 91% to $53 million in the first quarter of 2021 compared to $28 million in the same year ago quarter. And let's look at some of their operational highlights. Is their agent and brokers keep growing and increasing. Last year they had about 28,000 agents. They now hit over 50,000 agents, so that represents about a 77% increase at the end of the first quarter of 2021. So year over year growth of agents is up 77%, which is obviously going to bring more transactions, more revenue, and this company is literally basically operating with no debt. So they're expanding globally. Agents are jumping on board and joining this company like crazy. They have a disruptive business model by being 100% virtual and digital in this type of environment. So their tech is leading in the market, but yet the share price just keeps falling and falling. Now, guys, I like to buy stocks as the price keeps falling. That's my way of buying in, and that's what I like to do as far as investing. As if I see a price of a stock fall, but I see the technicals, but more importantly the fundamentals be strong, and the business model I see is working, then that lowers the risk, in my opinion, in my portfolio. So that's when I want to buy in. Expi's growth year over year has just been crazy. The stock price falling like this doesn't make sense to me. Like I said, they're growing globally. The agents are jumping on board like crazy. Disruptive business model. In my opinion, this stock is going to be a 3 or 4x in the next 5 years. So I've been buying Expi heavily in the last 2 to 3 weeks, and I have sold no shares of Expi, guys. I'm so convicted on this real estate company. Now, the last company I'm going to talk about is Comstock Mining. Comstock obviously is in precious metals mining. They do all that traditional gold, silver, copper, precious metals type mining, but they are doing smart mining. So this is a tech play, and they are looking for ways to add technology into their mining operations to lower claim costs, which will obviously make them more profitable. But what's exciting about this company is their transition into clean energy. So this is a tech play, green energy play, electrical vehicle play, as they have acquired a direct majority stake in a lithium ion battery recycling company called Linico. Now, some first quarter 2021 financial highlights is their total operating costs decreased by 127% from the prior year quarter due to lower mining and mine claim cost. And other income was $7.8 million in Q1 2021, a $6.8 million or 676% increase from the prior year quarter, principally resulting from a new derivative asset related to the investment in Linico. Net income was $8.2 million, and this company is operating with no debt. They decreased their debt to 0 at the end of 2020, which obviously, when you're buying into a company where the share price is going down, but the company has no debt and strong financial reports and strong fundamentals, you're obviously lowering your risk in your portfolio, in my opinion. Now, I'm not a financial advisor. You want to do your own due diligence when investing in stocks, but this company is undervalued in my opinion, and I'm going to continue to keep buying shares. The share price went under $3 today, and I bought heavily into Comstock. And right now, I think I'm sitting somewhere around 1,500 shares. I don't know, probably at an average price of, a little over $3 a share. So, haven't really had much gains in this company, but this is a long-term play for me. I know that the demands for electrical vehicle, I know that the demands for lithium ion and battery recycling are going to continue to grow by 2025, 2030. The market and the demand is going to grow, so obviously we're going to need to meet supply, and Comstock has really positioned themselves to be a leader in the electrical green energy space. They have recently done a remarkable job of rebalancing their balance sheet. Again, zero debt, so they're just gearing themselves up for some strong growth in the next 5 years, 10 years, in my opinion. So guys, let me know what you guys think about these three companies. If you think that they're a buy right now, if you think that the stocks are garbage, let me know in the comments below. But in my opinion, I'm convicted on these three companies. I'm going to continue to average down as I see the share prices go lower, because obviously fundamentals don't matter in the stock market right now. Stock market's acting completely out of whack, strange, but if you've done your due diligence, if you've done your research like I always say, then you should have some confidence, you should have convictions in the certain companies that you're continuing to buy into. So guys, that is just a quick update. Always want to be completely transparent in what's going on inside my portfolio. It's definitely been painful in the last 3 weeks because I'm just so heavily invested in tech stocks, but this again is a long-term play for me, so I'm not too worried, guys. Again, thanks for watching. Hopefully you found this helpful. If you did, give this video a like. Consider subscribing to the channel, as it always helps me out here, and I'll see you in the next video.